Oh, dude, Jacob here. Today we're looking at West Pharmaceutical Services in the healthcare equipment and supplies industry. 28.5 billion market cap on 27.7 billion enterprise value. Over double revenue of the last 10 years. Outside of the two COVID years, growth has been pretty solid in that 6 to 7 range, pretty close to a medical trend essentially. Um, Margins from 31.5% on gross to 38.3, and then operating margin almost doubling from a little over 12% to 24%, with return on invested capital also growing and almost doubling from just under 10% to 19%. So great stuff here. We're seeing a lot of positives from all of that. Balance sheet shows 854 million cash on hand, 134 million short-term debt, 73 million long-term debt. They can wipe off that debt with all the cash they have on hand. Very safe balance sheet. Absolutely no concern there. Reinvesting back themselves quite a bit. We see that their capital expenditures have over tripled. And the good news is, so have their cash from operations. So their free cash flow is expanding as well. Their use of free cash flow is maybe 5% acquisition, quite a bit of share repurchases, probably 50% or so. And that dividend is paying out maybe 15%, 20% of their free cash flow. So, with them having such little debt, I do want this company to be reinvesting back into themselves quite a bit due to their historical rate of return being very good. I do have to note though that if you repurchase shares, that does inflate your return average. That does inflate your return on invested capital due to the fact that it's based on the balance sheet. When you buy back shares, it lessens your shareholders' equity, even though the shareholders are getting that money back essentially. So keep that in mind, but still great return on the money invested. And so I want this company to be reinvesting back in themselves, buying back shares that are stupidly cheap, and paying a dividend with the money that they can't find anything else to do with. Going to give me a 10%, 8% return on it or so. So let's start making some assumptions. On the revenue growth side, honestly, 6% seems pretty reasonable to me. I think I wouldn't be like, I'm not saying they deserve a big premium, but I do think slightly above market at the end of 7 years, saying that they probably have a little bit more growth in the market, but due to them not reinvesting everything or as much of their free cash flow as possible into this 20% rate of return, they're just investing a little bit, then I think it deserves just a little premium. Margins, I'm going to assume I don't necessarily like that earnings margin are that much higher than free cash flow margin, but both are still double digits, so I'm not super concerned about that. Maybe let's do 17, 15 share change. So they've been buying back a lot of shares. So their stock based compensation is only 23 million. Oh, their PE is just very expensive. Okay, so them buying back 1% of shares would be about $285 million, which is maybe 65% of their 5 year average free cash flow. So that is a good amount. Let's say they buy back. Oh, that I said 1%. Oh, geez. So 1% is 285 million, and that's, like I said, a lot of their free cash flow. So I think that's fine. The dividend is little. What have they done historically? Increased it about with their revenue growth. So I'll probably do the same. Assuming that they really just keep the percentage of payout of their dividend the same, um, which actually roughly would be about 7%. Since you buy back 1% of shares, your dividend per share, it'd be easier to grow that as well. So I think those are all reasonable assumptions. Right now, I'm just saying that personally, buying back shares at a 48 PE, unless your company is growing double digits a year consistently, I don't think that's an attractive price to be buying back shares. And so I'm definitely turned off by that. I mean, it does inflate your PE, but it's a use of cash that's going to be reinvesting back into the business by buying back those shares. And so if the return of the stock is 5% a year over the next 10 years, they paid half of their free cash flow to give you a 5% return a year. Does that sound like a smart investment? Not to me. So I think that probably not the best time for them to be buying back shares in my perspective. I think personally, if you're at a 48 P and are buying back shares, I don't know how that's. I don't know how many companies that actually makes like a lot of sense for, due to the fact that if you get a 48p, I presume you're reinvesting a lot of money back into yourself to get a fat return. And if you do have money left over, maybe buying back a little bit of shares. But if you're not growing double digit, absolutely, I just can't see a 48p repurchase making sense. Hopefully you enjoy this video and hope you have a great rest of your day. Thank you.